Those are all true, but I think the structural underlying problem for why it's basically broken in every single country, and it's been broken for a very long time, is because we've kind of lived through this technological mismatch, and that's made it very hard. Basically, all the incentives in front of politicians and central bankers and policymakers in general aired toward making it very easy for them to break the trust and create problems.
Hey guys, welcome to Everyday Finance. Lyn Alden just dropped a powerful insight that every Bitcoin investor needs to hear. Adoption is ramping up fast, and available supply is shrinking by the day. In her latest breakdown, Alden reveals a pricing model that could completely shift how we think about BTC's future. The core idea: Bitcoin's price doesn't just rise with adoption, it accelerates, moving with the square of growing interest. That means each new wave of users and capital doesn't just push the price up gradually, it sends it surging. If this dynamic continues to hold, Alden believes Bitcoin is structurally on track to reach $400,000, and possibly much sooner than most people expect. She walks through the mechanics of her model step by step, making the case that this isn't just hype. It's math, behavior, and economics aligning for a potentially explosive move. Don't miss the end, where she breaks down why most still underestimate just how high Bitcoin can go.
So I try to describe it as a technological problem first and foremost, but that doesn't necessarily require really deep technical understanding. There's just some key points. And so I kind of separate the financial history into kind of three main eras. So the first era was pre-telegraph. That's when everything was analog. And so there were monetary technologies, things like coinage, things like paper and the printing press. We don't really think of them as technologies today, but at the time they certainly were these new technologies that allowed basically forms of ownership and money to move around quicker and transactions to move around quicker. But once they invented the telegraphs, that was the 1830s, and then by the 1860s, we had cross-Atlantic cables, cross-continental cables, and you could talk almost instantly or send low bandwidth signals almost instantly around the world. And that means you could do transactions almost instantly around the world. And the way that I describe the problem is that opened up a really big mismatch between transaction speeds, which could now just go around the speed of light almost, and settlement speeds, which at the time were still physical gold and other physical valuables. And the kind of the main way that they bridged that gap was to have a big centralized ledger. So either big commercial banks or in many cases a central bank that all the commercial banks build on top of. And that becomes a trusted layer that everybody has to use to bridge between settlements and transactions. And whenever there's a really big centralized honeypot, it's prone to manipulation. It's prone to people misusing it for various reasons and kind of breaking that trust. And the reason I look at that through that technological lens, because I think for the first time in a very long time, that gap is closed. Because Bitcoin, it represents multiple things, but in this context, it represents the invention of fast settlements. So after basically a century and a half, we finally had the settlement side catch up to the transaction side. And that, of course, took a lot more bandwidth, a lot more inventions that just had to be created over the course of that period of time. And so I would say money's been broken. It's partially because of individuals making decisions. So we can point to the creation of this central bank or this politician making this decision at this time. Those are all true. But I think the structural underlying problem for why it's basically broken in every single country, and it's been broken for a very long time, is because we've kind of lived through this technological mismatch, and that's made it very hard. Basically, all the incentives in front of politicians and central bankers and policymakers in general aired toward making it very easy for them to break the trust and create problems. So structural inflation, the underlying cause is growth in the money supply on a sustained basis. Now, you can have temporary causes of inflation, of price inflation, things like, for example, a war or a shortage, or other basically anything that harms productivity can make prices go up temporarily in a certain area. They will generally, if the money supply growth itself is not the issue, those prices will come down in time, and or they will lower the prices of something else that people aren't buying because they have to prioritize buying this thing that has gone up in price, if it's something core like food or shelter. Um, and but in order to get sustained, persistent price increases like we see today and for a very long time, it requires that the money supply itself is increasing. That's an axiom that's true everywhere. Um, and that primarily hits us in one of two ways. The way we normally think of it is consumer prices go up, or a typical basket of what a person might buy in a given year, that basket is increasing. And they're all happening at different rates. I mean, things like hospital services might be going up faster than the official inflation rates, while things like electronics might actually still be deflating because they're getting more productive even faster than the money supply is growing. And so they actually have a negative inflation rate in some cases. And the mix of all that together is we find that the average price of living a year of our lives, much like last year, is higher, which means that then Americans have to go out and try to get a raise, try to kind of keep up with that. The other way that it can manifest is it can show up in asset price inflation, which is normally not very captured in consumer prices. But basically, when you have a period of rapid money supply growth, but also pretty high productivity growth, so if the economy is doing a pretty good job of keeping energy well supplied and other goods and services flowing pretty readily, then not all of that money supply growth is going to necessarily show up in prices at the same rate. And a lot of that surplus will show up in things like equity prices, housing prices, gold going up and kind of capturing some of that, maybe the modern era of Bitcoin now. But looking at history, we basically any of these more monetary type of assets that are primarily owned by the wealthier, the upper middle class, and the middle class, those assets tend to capture a lot of that growth. But then that can make it harder for new entrants to want to buy those assets, which is particularly relevant for housing. So at the end of the day, it all comes back down to money supply growth, because that's a necessary part of, if we see inflation like on a persistent basis, it has to be because the money supply itself is also growing.
Lyn Alden just flipped the script on how we think about Bitcoin's growth, and why traditional models like Metcalfe's law simply don't apply. In a recent discussion, she explained that while Metcalfe's law works for platforms like social media and phone networks, where value increases through user-to-user interaction, Bitcoin is fundamentally different. It's not about connecting with others. It's about preserving wealth independently. People adopt Bitcoin not to communicate or build a network, but to shield their assets from seizure, inflation, and centralized control. That's why Alden argues Bitcoin should be viewed as a personal asset, not a network utility. And when it comes to what really drives its price, it all comes down to one powerful force: scarcity. With only a limited supply of coins and more people choosing to hold rather than sell, liquidity continues to dry up. New adopters are coming in, while long-term holders are doubling down. And that's causing supply to vanish from the open market. The result? Price doesn't just rise, it accelerates. Alden says this isn't a linear path, but a quadratic one. The more interest there is, and the less Bitcoin there is to go around, the faster price increases. That's the real engine behind Bitcoin's value, and it could mean we're heading toward much higher levels than anyone expects.
Yeah, I think that's a really big factor. I think when we look at a couple key things like house price inflation, as well as other big expenses like healthcare inflation, these things have generally been above trend compared to what we think of as inflation, CPI. And those are some of the biggest expenses that people have. And so back in like the 70s, for example, interest rates were quite high. And so in many cases, saving in bonds, especially by the time they got to the 80s, was considered more attractive. And you wouldn't necessarily want to go out and buy a house just for savings if you're going to pay a mortgage rate of like 10% or higher in many cases. So the average house price was lower, and people primarily looked at them as a utility thing. You need shelter, so you buy a house. As interest rates came structurally down, and as we went through multiple decades of persistent currency debasement and people realizing that if the money's weak, they have to save in other things. They have to monetize other scarcer assets if they want to preserve their purchasing power. One of the key things they go into is real estate. That's in addition to things like equities or gold or other financial assets, but real estate's obviously a very large and popular one. And so people can buy second homes and leave them empty. People can do all sorts of things. And they're willing to pay pretty high prices because if you're wealthy and you can get a 3% mortgage, while money supply is historically growing at 7% a year, many of them will pay up quite a bit for a house and then price out more price sensitive buyers. And so that has been a pretty persistent issue against the middle class and overall household formation and key metrics like how many hours of work it takes to afford a house. And some people will push back on that and say, well, houses have gotten bigger on average. Then the kind of the counter pushback is that they've also in many ways gotten lower quality per square foot. So if you knock on the wall of your new construction today, it's going to sound like balsa wood compared to what a new construction would have been like years ago. And of course, you've gotten better at engineering, so some things work better, of course. But on average, it just takes more work to afford a similar size and quality of house than it did some decades ago, and therefore it often takes two incomes, and people can feel like they're having trouble getting ahead. Yeah, I would say it's more structural, and much like a point I made earlier, it doesn't mean that human decisions aren't relevant. I mean, there are certainly countries where there's higher levels of corruption than other countries, so the problem can be more kind of exaggerated or more subtle. But overall, the kind of the main issue basically relates to the Cantillon effect. So the closer you are to the source of money creation, generally the more you benefit from this perpetually expanding money supply system. And so, for example, if you're a large bank, if you're a large corporation, if you're high up in these types of entities, or otherwise, if you're wealthy and you're able to access cheap credit for very long periods of time, you're kind of perpetually, in a self-reinforcing way, advantaged from that system. You're able to basically short fiat currency. You borrow fiat currency at a lower rate of interest than its supply growth rate. So you're shorting something that's losing its value, and you can go out and buy all sorts of financial assets, buy cash flow producing businesses, buy all sorts of things. Whereas if you're generally on the lower end of the income and wealth spectrum, it's harder for you to access credit. It's very expensive when you do get credit. And then you can, ironically, like you pay more for banking services just because you're dealing with fees and problems there. So it kind of becomes self-reinforcing to the downside unless you can have like a big jolt, like education or something that can help you kind of break out of that. And while there's always some degree of wealth concentration in any system, for a variety of different reasons, I think the kind we're more worried about is what we perceive as unfair wealth concentration. So someone invents a new widget that makes everyone's lives better. Most people they don't lose sleep over the fact that that person became quite wealthy because sure, they got wealthy, but they made everyone else essentially wealthier too. I think where we notice the problem is, especially in the financial sector, when you kind of look and say, well, is that person really adding to society, or are they kind of they kind of put themselves in a kind of parasitic position near the core of the system, so they're able to get out disproportionate benefits from that they wouldn't have in a more sound money system. The other big factor is that if you're really close to power, and power has a flexible monetary ledger that you can really print money, then you can get selective goodies or bailouts. And so, for example, for decades, the most lucrative thing you could do was go to Wall Street. Unless you're going to be Bill Gates or something and be an outlier inventor or something, the much easier path to riches was go to Wall Street, work in finance, and then eventually when that blew up, when they over leveraged themselves and blew up, they had enough pull with the government to get themselves largely bailed out, either in terms of direct capital injection or being given very low cost of capital, artificially low, right at the time when everything's cheap and no one else has access to low cost credit. Um, and so that combination is basically that the rich kind of keep getting richer and finding more ways to influence politicians to help them stay rich and get richer. Whereas if you're on the wrong side of that, your influence is weaker and you're working against these things that are kind of self-sustaining against you.
Lyn Alden just laid out a bold new take on where Bitcoin is headed. And it has nothing to do with hype or social buzz. Instead of viewing Bitcoin's price through the lens of speculation or network effects, Alden frames it as a function of compounding interest and a rapidly shrinking supply. Her argument is rooted in real, observable trends: steady adoption, a decreasing amount of Bitcoin available for trading, and growing conviction from long-term holders. These aren't just market cycles. They're structural forces that create the conditions for price to accelerate as more capital flows in. As interest builds and supply tightens, each new wave of demand hits a thinner and thinner market, causing price movement to become more explosive. If this relationship continues to hold, Alden believes Bitcoin isn't just on track for another run. It's poised for a breakout that could completely reshape our idea of what a top even looks like.